Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt. I look at the week's financial news that could be a bit confusing, misleading, and take you off course to make it actionable, understandable, and clear. What a week. And therefore, what a show, what a run list the producers have for us this day. We're going to be looking at the very best protection against an AI bubble. You guessed it, index funds by the granddaddy himself, Mr. Burton Malkiel, random walk down Wall Street. We also are talking a little AI. Are you buying the dip? An AI agent will do it for you. Fascinating look at the way AI agents are going to transform and are already transforming the investing landscape. And then we just look at Allbirds. You may have bought their shoes, but it's an interesting story and how a hotshot company can go to zero. No surprise, the importance of diversification. And then we end, a friend of the show sent this, when the CNBC network plays the Markets in Turmoil special. How would you do if you invested right when the special was going, right when they did Markets in Turmoil? You'll have to find out. Stay to the end. Bring the grandkids in. Let's talk first at the top about the best protection against an AI bubble. Burton Malkiel wrote this, the Wall Street Journal. Subheadline, you'll experience losses when a bear market comes, but most active managers will do even worse. I couldn't have written this article better myself. Now, you might argue, well, that's true of every article, Robert. You're not a professional, but in this particular instance, it was the content that was so wonderful. Mr. Malkiel, as you'll remember, he was maybe still is a professor at Princeton. And so some of you listeners I know have taken his class, very jealous. But he talks this way. He says a sentiment that's common among Wall Street professionals is the stock market is dangerously overconcentrated. The market value of the 10 largest stocks represents almost 40% of the total value of the S&P 500. And so market indexes, the argument goes, are insufficiently diverse, exposing investors to dangerous risk and making index fund investing an unjustifiable investment strategy. You heard that? Have you ever heard that? Let me tell you, I've heard it a lot lately. Well, he just breaks it down. And he's saying it's reached a fever pitch. So he talks about the professionals. This is where we started shaking our boots. Jeremy Grantham writes that we're experiencing a speculative bubble. That'll be under Howard Marks opines that index investors are unwisely pouring money into the largest stocks regardless of value. Bill Gross declares that indexing isn't buying the market, it's just owning a few stocks, all betting on AI theme. And guess what? Investment firms like JP Morgan, ever heard of it, and Goldman Sachs, ever heard of it, are telling investors that the narrow market makes actual stock picking essential. Now, you know my ears go up whenever JP Morgan and Goldman Sachs tell me active stock picking is essential. Heresy. Well, let's figure out, what does Mr. Malkiel say? Well, first of all, he says, is it unprecedented that a handful of stocks dominate the market and produce good returns? Yep. Hendrik Bessenbinder, a wonderful name. Can you imagine? Hi, I'm Hendrik Bessenbinder. Well, you're not going to forget that one. He indicates that almost all the wealth creation from equity investing was produced by a tiny fraction of individual stocks. I'm going to say that again. Just slow it down. All the wealth creation from equity investing was produced by a tiny fraction of individual stocks. For the 100 years since 1926, the U.S. stock market has returned about 10% annually. Did you catch that? 10%, 1926. But only 3.4% of the stocks were responsible for all the wealth creation. Only 3.4% of the stocks were responsible for all the wealth creation. The rest of the stocks combined did not produce net gains that exceeded the amount that could be earned from investing in 30-day treasury bills. More than half of the stocks in the market lost money. So what's the lesson, investor? And I know I've said this before. The generous average return, this is Malkiel saying this, the generous average return from the market came from a tiny handful of stocks. 3.4%. Can you imagine? You're looking at an ocean of 3,000 stocks, and if you're a stock picker and you're only allowed to pick 30, which is kind of the way they do it, only 3.4%. Only the 3.4% will actually get you the return. I'm sweating, guys. I got to tell you, if I was my job, I'd be sweating. Malkiel rightly says the indexing strategy works because it captures the rare winners. We cast our net and catch every fish. The small ones, the big ones, the tasty ones, the ones that taste terrible. So Malkiel lets us look back and he says, hey, a lot of people will point to the early 2000s when the stock market was nearly as concentrated with internet-related stocks, and stock prices declined sharply until mid-2002. Index funds lost half their value. And what they'll say is, if you just could have predicted the decline and shifted to value stocks, not been as growth-minded, you would have limited your losses. The problem is, you guessed it, class, no one can predict the market. When growth is in favor, when value is in favor. No one knows that. No one. No one. So wouldn't you know it, Malkiel, he talks about Standard & Poor's, SPIVA, active versus passive reports. What does he say? Active loses, even in those markets where the market's crashing. Active still loses. 59% of active funds underperformed the S&P 500 in 2001, and 72% underperformed in 2002. That's bad. That's bad. So Malkiel's summation here is, hey, today's stock market does present risks. It is possible that we're in an AI bubble, and stocks do go to extremes. The railroad boom in stock prices was followed by rail stocks falling by 3/4 of their value during the Panic of 1873. You guys remember that one? That Panic of 1873? Well, maybe not, but electrification revolution ended the crash of 1929. Dot-com bubble led to the crushing bear market in 2002. Some of these internet stocks lost 90% of their value. But we don't know. I think this is where Malkiel's brilliance comes to the fore. Where are we? He says, are we in the top of the third inning, the bottom of the ninth of the AI revolution? We have no idea. We have no idea when the stock market will fall. I don't. I certainly don't. And Mr. Malkiel closed it out saying this, and I want you to anchor to this, because this is what I anchor to. Having a substantial share of your portfolio in a broadly diversified low-cost index fund remains the most reliable method for building wealth in the stock market. Wow. I mean, this is why when you read Mr. Malkiel, you really got to just listen up, because it's almost always going to be gold. And he is the author of A Random Walk Down Wall Street. Now, let's talk agents. Agents. Headline, Buying the Dip. This AI Agent Will Do It For You by Hannah Aaron Lang. Public, subheadline, an investing platform will offer AI agents that can help put your brokerage account on autopilot. This is fascinating. Artificial intelligence agents can already help book your air travel, debug your software, and plan your workout routine. Soon they might serve as your stockbroker too. And let me tell you, listener, this is coming with a vengeance. So here's what they're saying right now. This public platform, it's a privately held brokerage firm. I've never used it. But what they'll do for you is you just tell it what you want. You want to do a put on oil. You want to hedge against stock losses. You want to do an auto sweep of your cash account into higher yielding assets. You want to sell under these circumstances. You want to buy under those circumstances. Any sort of strategy you want, these AI agents will do it for you. And you can really think about these as robots, but they don't have an embodied form. These are just software programs that are really, really, really good. And you give them a little instruction and they can just go off and work. So Public does it, this private group, and there are other platforms, Webull, Robinhood, Betterment, that they are starting to have these AI solutions for each part of your portfolio. And they're going to have tools that will talk to you about the stocks. You ask them a question, analyze earnings, make you custom indexes, which of course I'm scared of, but this is just the first inning on this stuff. I think and usually this is the way I see it working. Some of these strategies will be tried with the smaller brokerage firms, and we'll see what works and what doesn't. And then the Fidelity, the Charles Schwabs, the Vanguards will roll out what is successful and what is not successful. You won't see the light of day on the big boys brokerages, but these more entrepreneurial, smaller brokers, I think you're going to see a lot of innovation in this space. I can, as always with technology, I can see the good and I can see the bad. So what's the good? If you followed direct indexing at all, this is a program of investing where they make you buy 500 stocks. Don't buy the exchange traded fund index, buy the 500 stocks, and we'll buy and sell, your individual stocks when they go down, capture the loss, and charge you. Right now, Schwab charges, I think, 0.30, 0.40%, but it's super messy, and no human's going to ever keep up with it, and you can never leave. It's a Hotel California, and it's expensive, and in my view, not worth it. If these AI agents really get going, I could see tax loss harvesting being something if it ever came to Vanguard or Schwab or Fidelity, meaning, hey, if your exchange traded fund dropped considerably from where you bought it, you could sell that fund, buy an equivalent exchange traded fund, but different enough to not violate that wash sale rule the IRS has, and let the AI agent do it. Just give it in the instructions. Say, hey, here's what I want you to do. If this ever happens, do it for me, but do it all in a way where you're not encumbered by some 1% AUM fee or some 0.80% AUM fee or some commission structure. The AI agent really works for you, not the brokerage company. This is where it'll take the wisdom of Solomon for people. A bunch of these agents are going to suggest things that are not that great for you. And you're going to have to know more than the brokerage company about investing, what's best for you. Otherwise, these agents will run you ragged. Same way humans do. The humans are going to program the agents. You better believe the agents are going to suggest products to you and strategies to you. And if you don't know your stuff, you'll get smoked. My positive spin on this is, I do think, I want to get all the security risk. I mean, there'll be a couple of security blips on this. They'll figure it out. I do see this coming where you'll log into Schwab or Vanguard or Fidelity, and there will be some toggles you'll hit, and you'll be able to say, hey, look, I want to do a tax loss harvesting strategy. If this ever happens, execute it for me, and it'll do it. That's a brave new world of investing, and that's this article in the Wall Street Journal, and I thought it analogized it in a helpful way. They said this is a fundamental shift in how individual investors will manage a portfolio. And I'll say this, as Mr. Do Nothing All Year and low-cost index fund, to keep it simple, it won't affect people like us as much, but there's still going to be some things you're probably going to do. And that I suspect we will, once the dust settles, utilize things like this. And they say this is revolutionary for retail traders as computers and mobile phones start trading, both of which, by the way, were good, abused to be sure, but good things. It wrested power away from the large incumbent banks and let the individual be empowered to do their own investing, which, by the way, is your best shot at getting decent returns, because no one cares more about your money than you do. And our final article before we get to our CNBC special is Allbirds, a shoe company, once valued at $4 billion, just sold its assets for next to nothing. Subheadline, the once high-flying company agreed to sell its intellectual property to American Exchange Group, whose brands include Ed Hardy and Aerosol. So why did this make the show? I think it behooves us to remind ourselves how difficult individual stock investing in, how difficult private investing in, and how little we know. This should be an exercise in humility. Whenever we see something like this, where a company, and many of you know the Allbirds brand, you've seen the shoes, when you see something as high flying as Allbirds, no pun intended, take a bath like this, it should give us humility that we probably don't know which companies will succeed and which companies will fail. Probably don't. You remember the last article or two articles where Mr. Malkiel told you just what percent of the companies actually were responsible for the returns, 3.4% of stocks. Well, you better believe in the private space, and we'll tell this Allbirds story. So it was once valued at $4 billion with a B. It just struck a deal to sell most of itself for $39 million. That's a big old swing. And it's also 1/8 of the $301 million it raised in its IPO in 2021. So, I mean, that's a big swing. So this was founded in 2016 by some folks. Their product was super popular. They got into the online disruption space, and they're selling directly to consumers. All systems go. If me or you or anyone else looked at a pitch deck of something like this at the IPO, we'd probably say, oh, this feels can't lose. That's what I'd say. Gosh, they're selling like hotcakes. And they had a great corporate story. They wanted to be green. They wanted to be good. They wanted to be high quality. They wanted to change the way people saw shoes, and they did. They sold a ton, and they were cool with a lot of 30 and 40-year-olds. Well, they tried to get in other product categories and get out of their main focus, and sometimes that works. In this instance, it didn't. They bought a bunch of product that didn't work, lost a ton of money. When they messed up, a bunch of other brands came in, so that moat wasn't as strong as they thought it was. And they lost more than 95% of their value since the IPO in 2021. So the deal still has to be approved by stockholders, but anytime you think something's a can't miss, quick money, I know the product. You've heard perhaps Peter Lynch, the famous Fidelity investor, Magellan Fund. He was big on, hey, if you use the product, if you know the product, that's a big deal. Anchor down to that. Well, you could have loved Allbirds, known Allbirds, seen the sales figures, and just not known that the executive team would take a big risk in other categories and tank the company. How could you have known that? Well, I don't know, but it's just another reminder. Let's buy it all and just presume we don't know that where that 3.4% is. And then I thought this was funny. Friend of the show sent this in. If you ever watch CNBC, you probably shouldn't. I've noticed it started to hurt my head when I listen to CNBC because there's so many falsehoods about the nature of investing implicit in most of the stories. I watched something on CNBC the other day, and the interview was so contrary to orthodoxy in the investing space, I couldn't do it. I couldn't be lied to that much, but all right, they have a markets in turmoil special. Had you invest in the S&P 500 every time they did their markets in turmoil special, your average return after 1 year would be 40% with a 100% success rate. Can you imagine? This is so May 6th, May 7th, May 9th, June 4th, August 7th. This is of 2011, 2010, and they have just a jillion of these dates. 2020, a bunch of 2020s, bunch of 2020s, markets in turmoil. And so what's the lesson? What I don't want you to do is say, oh, great, I'll just wait for the markets in turmoil special and I'll invest. First of all, I think it'll actually be harder than you think, even though there's a 100% success rate right now. Secondly, as humans, they should remind us, oh, this is a hard game. This is a hard game. We don't know when the right buy time will be. This is a funny indicator. Of course, I don't recommend you trying to replicate this. It's kind of a funny indicator that when the television anchors say, oh, things are crazy, markets are in turmoil, well, that was actually the time to buy. And when things are up and everything's green, it's probably the time to sell. But what's the solution? You know me. Don't try to time it. Just own the market, own it forever. No market timing. It'll be much better for you. And stick to the basics, where we're going to keep our cost low, investing simple, and time horizon long, because that is what's going to give us the best shot on our investing journey. Until next week.